Okay, what we want to talk about today or start our discussion off with, we called it last time interest risk or market risk. Okay, and sometimes there's just a little bit of a twist to this where it might be called interest rate risk, but it's the same idea, whether you put the rate in there or not. Okay, and let me just kind of show you a simple idea. We'll put a bond up here, some $1,000 face value, maybe a 4% coupon interest rate, and 3 years hence. Just as an example, and we'll have a discount rate maybe 5%. And then if we calculate this, it has a present value to us of $900, I have it written down here, and $72.77. Okay? Now, the idea, and this is the price in the marketplace. Investors will be out there and discounting this future flow of dollars, the $40 a year that we receive as the coupon and the $1,000 that we receive at maturity. Investors are discounting those dollars, and so would only be willing to pay $972.77 for this bond. And so the idea of interest risk is this. Suppose you buy this bond and you pay that price for it and you say, hey, I feel good about this. I'm going to get a 5% return on my bond. And then after that, suppose the marketplace changes and both you and other investors say, you know, I need a 6% return on my money for whatever reason. It could be that there's new risk introduced into the situation. It could be that there's inflation that comes along. For whatever reason, now I need a 6% discount rate. Well, what's going to happen is the value of this bond in the marketplace is going to go down. If there's a higher discount rate, a lower market value for the bond. I want to draw a picture. It kind of illustrates this idea. And it's a simple picture. We'll put the interest rate on one side and prices, market values on the other. At the moment that bond comes to market, like if you're running a company or you're running a city or whatever and you're issuing a bond, here's what you do. You investigate that marketplace. And what you want to do is you want to put a coupon interest rate on that bond. Here we had 4%. You want to put a coupon interest rate on that bond that reflects market conditions. What's the market look like today? And you look out there, survey the situation, and by the way, people who issue bonds don't just print them up, you know, like on their copy machine. They hire advisors, underwriters, and so forth, and these advisors tell them what the market is. I think we're going to be able to borrow that money for 4%. And so you put that bond out there with a coupon that reflects market conditions. And the moment that bond is finalized, when it goes out the door to be sold to investors, I'm going to put a little bar over this. That rate is locked in. That's it, 4%. Although in different situations it could be 3% or 8% or whatever the number would be. Okay? And at that particular time, let's see if I can do that in a horizontal line. At that particular moment, this has got a par value or a face value. In this case, $1,000, and that is its market price. I've used three terms for that: par value, face value, and maturity value. So anyway, all of those the same. You know, I can do better than a downward sloping horizontal line, whatever that means. I think I can. That's better. And the moment that bond goes out the door, when you sell it, this is locked in. The par value, the face value, it doesn't change. It says $1,000 on that bond, and it says 4%, and it's always going to say that. And so I put this little bar over each one of these because that's locked into place. Here's what's not locked into place. Market interest rates and the market prices of bonds. That's not locked in. You sell it with a coupon that's set at the market, and you charge a market price to people, whatever it says on the face of it. So when this bond was sold brand new, the first day it went out the door, yeah, $1,000. But now after that, that bond takes on a life of its own. And what happens is, over time, we talked about some reasons last time, that over time, due to risk or inflation or various circumstances, legislation, tax laws, interest rates, discount rates, and that's what we're talking about here, discount rates change. And as those discount rates change, the market price of these securities changes. And the idea, this picture here, is to illustrate the idea of interest risk. And what we've said is this: if market interest rates go up, then the market price of those securities goes down. And this is what we mean by interest risk or market risk on bonds. You might say something like this, or think something like this: hey, I bought a bond from the Treasury. There's no risk. If you have those thoughts, what you really mean is this: there's no default risk. There's no credit risk. I'm not worried about the government defaulting on this bond. And that's one kind of risk, and the risk on that is there's risk on everything. You know, like a meteor could crash into Earth and kill all living life forms. But other than that, you might say there's no risk. Okay, I'll grant you that. No default risk, no credit risk, but there is still market risk, and that's what we're talking about now. Because the moment you buy that bond, you said, I agree to accept 4%, and after that, you and the rest of the world may say, 4% is not very good. And in this case, maybe we say, oh, I need 5%. And if you say, I need 5%, do this. Buy this bond, get a 4% yield. I already had a case, didn't I, where if the market rate goes up to 5%, the price of that bond will go down to how much? $972.77. Interest rates in the marketplace up, bond prices down. Now, how do I know that's going to happen? Think about this. You buy the bond. Let's say you buy it at this moment. 1 second later, that bond is for sale. I mean, you own an asset. There's a market for that asset. You can trade it in that market. That's one possibility that you have. Oh, that was a 3-year bond, wasn't it? I better take this off of here because the specific amount isn't important. That was for a 3-year bond, and I didn't mean to draw a graph that's specifically a 3-year bond, or for a 3-year bond. You've got this bond. You're holding on to it. There's a market out there. You may need cash at any moment. You think not. You buy a bond and you're thinking, I'm going to hold it for a while. But potentially not. Something could happen tomorrow. You go out, get in a car wreck and say, oh, I got to get my car fixed. Oh, I'm in a hospital. Oh, I got laid off work. I need the cash. I've got an asset. There's a market. I'm going to sell it. So let's just say that you bought this bond and it's got a 4% coupon. And what that bond says to you is, hey, we're going to send you $40 a year. And right after you bought that bond, market conditions change, supply and demand and so forth. Market conditions change. And when this discount rate's 5%, what that means is, in the marketplace, there are brand new bonds that are coming out. And those brand new bonds say $1,000, and those brand new bonds say 5%. Because that's the new market interest rate, the new discount rate that everybody has. And here's a 3 years hence, or whatever. And so if you say, I want to sell you this bond, you've got a bond, this one, you want to sell it, so you say to somebody, hey, would you buy my bond? And they go, yeah, of course, I'll buy a bond. I invest in bonds. And you say, okay, I just paid $1,000 for this 5 minutes ago. They would go, huh, well, I'm not paying you $1,000 for it. And you say, why not? I just paid $1,000 5 minutes ago. And they say, you know, because there are brand new bonds coming to the market, and they pay $50 a year. And this bond that you're trying to sell me for face value, it only sends me a check for $40 a year. Why would I buy your bond from you if I can get a brand new one? And it's not the newness issue. If I can get one that pays a $50 coupon, I'm not interested. And you say, boy, I wish you would. And the other person says, you know, this is not about friendship. This is not about me punishing you. This is about business. And the business is, your bond that you're trying to sell me pays $40 a year. The new ones are paying $50. If you want to sell me this bond, you got to discount the price. You got to lower the price. And so here we go. Market interest rates up. And this is the market price of a previously issued bond. And that's our story here, is it's a previously issued bond. It's out here in circulation. The price of that previously issued bond goes down. Now, let's don't get hung up on this 3-year bond. Let's just think, and the numbers I'm going to tell you don't work out exactly right, but intuitively I want you to see this, and then we could use our calculator to get an exact number. But intuitively, think through this process. Let's just say this is a 1-year bond. Okay, and so we've got this 1-year bond. You just bought that. It matures a year from now. Here's a 1-year bond. The brand new one's paying. So here's a $50 or a bond that's paying $40. 1 year from now, that's it. In 1 year, it's all matured. This one is paying $50. And so if you tried to sell me this bond, I would say to you, you know what? These bonds look alike except for one thing. I'm going to get $40 out of this one. I'm going to get $50 out of this one in coupon interest. Both of them mature the same day. Both of them, I'm going to get $1,000 back. But this one only 40, this one 50. I'll tell you what I'll do. I will buy your bond from you, but I got to have that extra $10. I'll tell you what I'll do. I'll give you $990. And if I pay you $990, I feel good about that because I'm going to get the $40 coupon, and I'm going to get a capital gain of $10. And with the $40 coupon, the capital gain $10, that's $50 return on this bond, and a brand new one will be $50. I'll give you $990. Now, that's not exactly right, but that's pretty close. Sir?
Does it work the reverse?
It works the opposite way, too. Let's say that a brand new bond came out. Okay, the brand new one's a 3%. You own this bond, and you say, hey, I've got a bond, but I need some cash. So you go out in the marketplace, you say, hey, I got a bond for sale. You want to buy this? And all these investors are out there going, boy, the bonds that the government, I wish I'd bought one of those yesterday because yesterday they had a 4% coupon and today they just have a 3% coupon. I'm just going to get a $30 interest payment by holding this bond. And you go out there and you say, hey, I want to sell this bond. Anybody want to buy it? And everybody in the country, not everybody in the country, but hundreds of people go, I'll take it. Here's $1,000. They want to pay you before you get your wits about you. And you say, how come everybody wants my bond? And somebody goes, I'll tell you what I'll do. I'll give you $1,001. Everybody else will pay you $1,000. I'll pay you $1,001. And somebody else will say, I'll give you $1,002. Why would they pay extra? And the answer is, because your bond's going to give them $40 income, and the brand new one's coming to the market's going to pay $30. And so what happened is people would start competing. Other investors that want to buy your bond, they'd start competing, and they would bid that price up to how much? $1,010, right? Close. You know, it's exactly right. I just put the zeros in the wrong spot. $1,010. And so then, if somebody bought your bond, what they would be thinking is this. I'm going to get a $40 coupon, but I'm going to lose $10 on a deal, a capital loss. And that $10 loss, subtract from the $40 coupon, I end up with $30. And so what we have, I only drew one of these, but what we have also is, if market interest rates go down, then bond prices go up. Okay? Now, this is a story I just told. It's not really right. We haven't gone into how you calculate yields yet, and we'll do that in a little while. It's not exactly right, but it's pretty close. But it's intuitively, the thinking is exactly what's going on in the marketplace. Let's erase and do this slightly differently. I'll just erase right here. I'll well, I'll just erase that whole thing. And what we want to do now is, let's talk about a 2-year bond. Okay, this bond's coming to the market, you buy it, you get a 4% yield, you pay face value for it. Now you own that bond, and you feel good about it, okay? And then now you need to sell it, you need some cash. But just before you can sell it, interest rates go up from 4% to 5% in the marketplace. The discount rate's higher. And what that means is there's a brand new bond that comes to the market, and it says $1,000, and it says, we'll say 5% 2 years hence. And so you say, hey, who wants to pay me $1,000? Nobody speaks up. Come on, $1,000. And investors say, why would I pay you $1,000? Your bond pays $40 a year in coupons. The new ones are paying $50. And you say, okay, I see your point. I'll knock $10 off because this one only pays $40 a year, this one $50. I'll knock $10 off, I'll charge you $9.90. Is that a good deal? And investors say, yeah, that's not going to work. Because this is a 2-year bond. And so what's going to happen is I'm going to get $40 per year, $40 in the first year, $40 in the second year. This one's going to pay $50 in the first year, $50 in the second year. That's $100 altogether in coupons. This is $80. You want to sell me that bond, you knock $20 off the price. Is this making sense to you? And so the price goes down to $9.80. And I'm not going to do it in the opposite direction, but if interest rates went down to 3%, its price would have gone up by $20 to $10.20. Let me come over to my picture, and I want to add something else to it. Before, what we had is the idea of market risk, this inverse relationship. What we added to that is to say that market risk increases with years to maturity. And what we just saw is if we had a 1-year bond, the price fluctuated by $10. It went down from $1,000 down to $9.90. Yes, here's $1,000. The par value, and here's $9.90. And that was when interest rates went up from 4 to 5%. But if interest rates go from 4 to 5% and it happens to be a 2-year bond, then the fluctuation was down from $1,000 to $9.80. And so the longer the term to maturity, the more that price will go down. Okay? For the most part, there are a few exceptions, but for the most part, the longest bonds in the United States are 30 years. Few exceptions to that, but you're not going to run across those very often. Usually, if you see an exception, it'll be some kind of a municipal bond issued by some city or county or something like that. The United States Treasury, its longest bonds are 30 years. Most all corporations, 30 years. And so if the interest rates go up in the marketplace, the bonds that suffer the most from this market risk are the 30-year bonds, the longest bonds. And their prices will go down by a lot. And so you might go out and say, oh, I'm going to buy a Treasury bond. This is great. I'm an investor now. I'm not running any risk. And so you buy a 30-year Treasury bond, and you're sitting around, and you get a 4% yield, and it's almost for sure the next day, after you get that, interest rates will go up, and the price will start going down, and you'll say, how could this happen? This is the safest thing in the world. And the answer is, it's safe that the government's still going to be in business. That is to say, there's not much chance of default, where they just go, you know, where we promised to pay you back $1,000, well, we're not going to do it. That would be default risk. It's safe about concerning that kind of risk, but the government does not guarantee you that interest rates, discount rates, won't go up. They just can't do that. Interest rates can go up, and when they do, bond prices down. By the way, before we move on, let me say this. It's not only bond prices. Later on in this class, we're going to talk about banking. And what bankers do, sometimes bankers buy bonds, treasury bonds and things like that, but bankers make loans. And so like if you go down to the bank and you say, hey, I want to buy a house and I need some money. And they say, that's good, fill out this loan application. And then, you know, they go through this lengthy process, and assuming that they approve you on this loan, what they say is, how much do you need to borrow? Oh, I need to borrow $100,000. And so they'll say, okay, $100,000. And then they'll say, okay, that's a 30-year deal. And most mortgages are long-term. 15 years would be short, 20 be medium term, 30 years would be long. So a 30-year loan, and then they'll say something like, we're going to charge you 5%. How much does this look like a bond? There's this face value on it. There's this, what you could call a coupon interest rate. That's not what they call it on a mortgage, on a home loan. But there's an interest rate mentioned on the face of it that has to do with how much interest you pay every year to the banker. And then here's a maturity date. Huh, looks like a bond, huh? And so what I'm saying to you is this. If you're running a bank and somebody comes in and you lend them money for a home and you start accumulating these pieces of paper, you're accumulating something that looks very much like a bond. And then if interest rates start going up, this is locked in, right? There is such a thing as an adjustable rate mortgage, but a fixed rate mortgage, which is what most people want, that rate is locked in. And after that, if interest rates go to 6%, 7, 8, and so forth, every time those interest rates go up, 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 up in the marketplace, you the banker, you the lender, you go, oh my gosh, if I want to sell this mortgage to an investor, and there are investors that buy billions and billions and billions of dollars worth of mortgages. But oh my gosh, interest rates are going up in the marketplace. If I want to sell this mortgage to an investor, the value is going down, 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 down. So this is not just a risk. Interest risk is not something that just affects bonds. It does affect bonds, corporate bonds, treasury bonds, municipal bonds, but it also affects loans. A loan with a locked-in interest rate, and that was where we started with this picture, where that interest rate's locked in. One final thing before we go on, and it's maybe more than one final thing, but anyway, it's this. There is such a thing as an adjustable interest rate. And so if interest rates went up to 6% with an adjustable interest rate mortgage, they come back and go, oh, you know when we loaned you that money for your house? And you say, yeah. And you say, you remember when we loaned that money to you for 5%? And you say, yeah. And they say, well, now that's 6%. And you go, huh, that's interesting. And they say, now your house payment just went up. And you say, really? And so an adjustable rate mortgage would insure the banker against that kind of risk. But most mortgages aren't that way. And by the way, if you get one of those adjustable rate mortgages, the banker is insured against that kind of risk. You're assuming that risk. And so you should be able to get a little bit better interest rate just for taking on that risk. But anyway, so what I'm saying to you, there have been lots of banks and savings and loans and mortgage lenders that go out of business because of this. They have loaned money for mortgages. They got a huge portfolio of these mortgages. The interest rate's locked in, and then market interest rates go up. The value of the portfolio goes down. And their net worth is going down. And once that is a negative net worth, once they have eaten up the capital of the owners in the bank, they close the doors. And they're eating it up pretty fast because that's 30 years. You know, if there were a one-year mortgage, interest rates up, okay, we lose a little. Well, guess what? Those are long-term mortgages. Now, this is the final point. I have talked to a number of bankers, and here's what they say. Yeah, I make home loans or mortgage loans all the time. And as soon as all the paperwork is signed and the ink dries, I take that and I sell it. I do not hold on to this for a day. It's gone. Why? I don't want that risk. I don't want that market risk. I just don't want to play that game. Okay? And so anyway, a lot of banks make a lot of loans, mortgage loans, but they do not hold on to those very long. Sometimes savings and loans and some other mortgage type lenders, they will hold them, but bankers just don't like that kind of risk. Okay? Now, what I told you a moment ago is this, and I don't want you to be confused. these amounts that I was putting up here, like 990, 980, those are not exactly correct. I did not get my calculator out. What if this were a 3-year loan? The way I talked my way through it, if interest rates went from 4 to 5%, we'd have to discount that $10 each year, right? And then it would go down to $970 if this were a 3-year loan. Well, we know that's not true because we already did that one calculation. It went down to $972.77. And so the numbers I was putting up here were the kinds of numbers that we can calculate in our head, think our way through it, and see the concept of market risk or interest risk. But that doesn't mean that that number is correct out. And you can see right now that it's off almost $3 on a 3-year loan. But it's off by more the further out we go that way. Okay, so anyway, everybody okay with this deal? Interest rate risk. And it's out there all the time, and that affects banks in a big way. And bankers do not like to hold long-term bonds, and they don't like to hold mortgages. And I'm speaking in general terms. Okay, let's calculate yield. Yields, interest rates, rate of return, depending on the situation, you'll hear the terminology slightly different. I'm going to use that lowercase letter I to stand for interest rate or yield. I'm going to write something down after that, but I want to mention to you, well, let me write it down first. The way we mean this, the yield or the rate of return or the interest rate is the return from lending or investing $1 for 1 year. Now, $1 for 1 year, what we do is this, we standardize information about interest or a return. Suppose somebody said this to you, wow, last year I made $10,000 in interest. Is that good? Well, it's not so good if they loaned out $10 million. If you loan out $10 million to somebody and you get back $10,000, you didn't get much. If you lend out $50,000 and you get $10,000 in interest, that's a lot. So loans are of different sizes, right? And so what we have to do, if we're going to start comparing interest, we need to do something to standardize the amount of interest so that when we talk about interest, we're all talking about the same thing. And so that's what we do is we say, look, I'm going to just take however big my loan is, if it's a $100,000 loan, if it's a $5,000 loan or whatever, I'm going to take all the interest I get and I'm going to divide it by the size of the loan, so I'm just talking about $1 worth of that loan. If I get $10,000 in interest and it's a $100,000 loan, how much interest would I have gotten from just $1,000 of that $100,000 loan? Oh, I would have gotten 10 cents. And then the other thing is, when we loan money, some loans are for short term. You know, there are loans for 1 day. There are loans for 30 years, and there's loans for any maturity in between. When we talk about loans, we need to have some standardized way of discussing this, and that's really what this is. If we don't want to worry about the details and just say, I got $10,000 worth of interest and that's enough, okay, but it's not enough. It's confusing when the world's that way because loans are of different sizes and there are different terms, and so what we do is we take all of our interest rate information and we boil it down to $1 worth of loan for a 1-year period. And then, if we see a number that looks like this, 0.04, then that says, you know what? If I loan money out $1 worth of this loan for 1 year, I'm getting back 4 pennies. And then that's a 4% interest rate. And we say 4%, but that 4% means 4 pennies per dollar loan per year. If you want $100,000, well then you get $100,000. Yeah, you get 100,000 of those 4 cents. Are you with me? Okay, so anyway, we always do it that way, and next time we'll have a formula. Bring your calculator, and we will work our way through 3 of these interest rate calculations. So long.